Hey everybody, this is Paul doing a quick video. Today is January 30th. The market is currently open. It's 12:20 p.m. Central Time, and I think now's a good time before the Fed meeting and all the different earnings reports and all the different central bank meetings around the world to, do a video on my thoughts and see if maybe I could be accurate or kind of guess what's going to happen here. So what I want to do here is I want to pull up this tweet here first. And this is from the Bank of America trading desk. You have 109 XPX companies, so you know SPY companies reporting. You have the Federal Reserve, Bank of England, ECB. This is manufacturing numbers, non-farm payrolls, by the way, right here. That's going to be a big one. ECI, I forgot what now, our consumer index. I think that's how consumers feel. Euro area, just different things come in. Euro G, confidence data, all in one single week. So what I basically said is, if the market ends up trading flat this week after all of that, I'll be amazed. Um, the bears are going to kind of run out of. They're just running out of different things that they can talk about. So they have to start talking about the second half. That's the only thing they got left. Um, So let's look over the portfolio. As you're going to obviously see, I did some major, massive changes to my portfolio. So I'll explain why and what's going on there. So basically, you'll notice that majority of my portfolio is now passive ETFs. Um, so I'll go over the passive ETFs real fast. This one's actually going to sell off later tonight because it's a mutual fund. So this right here is utilities, international tech, domestic tech. Both of these have tax advantages, by the way. A lot of people do videos on these too. You can look it up and just kind of see what I'm talking about there. But so that's kind of how I want my exposure to tech to be. So you'll notice that it's not QYLD, for example. O is the only stock, I guess if you want to call it that. But this might as well be a passive ETF of real estate, of commercial real estate. AFB is municipal bonds, municipal funds. I didn't go with Muni. That's the big one that everybody goes with. Um, Same tax advantage account right here. So this is like tax. I don't get taxed on this. Now, if I sell it for a profit, these shares for a profit, if I buy low, sell high, that'll, you know, that'll, uh, that'll incur a capital gains tax. And then we have SPHD. This is low div or high dividend, low volatility. You can see right here. Um, if you're wondering why I didn't do SCHD or SPYD, those types of things, or like a Vanguard ETF, for example, or something. Um, Basically, the main reason why I didn't do like this right here is because that's quarterly. This pays out monthly. So that's my biggest thing right there. And it pretty much invests in the exact same things. Like SCHD has actually been around less time than SPHD. Um, so what I wanted was something that's been around much, much longer, um, and also has consistent dividend history. And if you take it all the way out, you can say max. So you can see it's been around since 2014. You can see the dividend has consistently been paid out. The dividend has increased. It moves around with the stock price. Pays out every single month. Very consistent in dividend payer. Low fees, that type of thing is what I was looking for there. So that's why I went with that monthly. Plus, it's been around longer. Um, so that's kind of where we got here. So why did I get rid of what I got rid of? So what I want to do is I want to pull up probably this screenshot here. I don't know if it's marked on here. So this was the prior portfolio and how it looked. You can kind of see what I kept, what I didn't keep. So basically any individual stock names. So you might be asking, well, why did you get rid of individual stock names? And the simple reason is because I've been putting a lot of money into SPHD. The problem is when I went into SPHT to see what it's actually made up of, probably about 10 of these 15 stocks down here were in SPHD already, and I dumped 3M after that earnings call because that company is a complete and utter mess. I've been wanting to get out of Intel for a long time because that was just a horrible bet that I made right there. That was just a value trap. the management there has no idea what they're doing. So they're just punishing shareholders in that stock. So January gave me the opportunity to offset these losses with wins from other stocks, so like Starbucks, for example, JP Morgan. You can kind of see where my winners were, um, and you just kind of see. And then also, like pretty much every stock that I own was already in SPHD or GABX, for example, because this is a utility ETF. So it made it very easy to basically justify just pulling everything out of here, and then also having to follow every separate stock here is becoming very tiresome. I prefer to just basically, so this is my investing, what I want to do is basically, that's my investing thing. So that's what I prefer to do. So if you look at my other portfolios that I have, you can kind of see I've already done this a long time ago. So this is my other portfolio, the smaller portfolio I have. This is my IRA, for example. You can kind of see it's all passive. And then you can kind of see why I would head that direction here. Now I might add a stock at some point, but I'm not doing another 15, 17 stocks. Even Gen X Dividend Investor, a guy I really respect on there, has had trouble kind of keeping track of all the stocks that he has. So, and also what I wanted to go over is something else, is this is the amount of data from just the last time I did a video till now, and this is also missing charts. So I kind of want to go through all of this. These are like different charts with like different lines. So this is a chart that actually kind of shows what the bears are talking about, like what might happen. So you get the bulls get their way, we get the breakout above, and then the bears are talking about basically this is what happens at the rest of the year. Okay, so take the bear case with a grain of salt, because this is literally what bears are telling you is going to happen. That's literally, if you look at bears, they're telling you that it's going to go below the lower lows right here. So these lows right down in here that you see, and it's going to break down to these lows down here in the 3,000 range. Some, bulls are telling you it's going to go up to here. So this is a straight line that goes that way. So that's getting annoying to follow, because there's data on both sides that literally proves each person right. So you can kind of see. And I did a little chart here that actually says, here's the bear chart. Unemployment increases, earnings decline, Fed hikes too much, something breaks. Nobody knows what that something is. CPI more sticky, so it gets to 4% and then it stops. And they want it at 2%, and then to get it to 2%, you need to call it a recession, because you need to have a whole bunch of people unemployed, or at least that's what they say. Bulls, employment stays strong, earnings do not fall much, and guidance is stronger. Fed either pauses or pivots. This is the big one right now. CPI starts to fall quickly, leading to the above. So basically what this says is that the CPI goes down to 2. The Fed realizes, well, we're sitting at 5%. We don't need to be this high, and they start to cut. So pick whatever you want. There you go. Pick one. Whatever camp you're in. It's really annoying trying to follow these guys. So these are basically, let me see, this is just the amount of money that should have just been put on the sidelines. Like how much money is actually saved on the sidelines, ready to come back into the market. So these are money market funds that just basically glorified savings accounts. This is where people are putting their money. And there's a lot of the money just kind of sitting there. You can kind of see. Just different graphs showing the bullish case. So here's the bullish case. Call the cup and a handle. And then drawing lines telling you it might take off that direction. Here's profit margins coming down, as you can see. So our profit margins returning to the 2019 level, where we're going to kind of go this direction, or profit margins kind of do something like what you see right here. They're going to go down. Here's something else. This is another chart that backs up something I keep constantly saying, because people on Wall Street are just so amazingly out of touch. They just can't figure out why when the Fed increased rates, the economy just didn't collapse. It's just the weirdest thing I've ever seen. 30% of the CPI report, the inflation report, is owner's equivalent rent. If you are on a fixed mortgage or you are on a house that you already own, that part of the CPI does not even apply to you. So you just subtract that out. So it says whatever number it says right now, like 7.5 or 6 point whatever on it. You subtract out 33% of that, it doesn't even apply to you. Okay? For some reason, Wall Street assumes that this top part up here, rental or other, is the entire economy. I have no idea what they're talking about. They're so confusing. Every chart that looks like this is basically says this. So it's so strange. It's just weird. I don't know what Wall Street's thinking. There's charts that, and this goes back to 2019, but I mean this data hasn't changed too much. It's pretty much almost like, actually, if anything, housing people bought more houses during the pandemic, so it's actually probably up here. So just remember that when somebody's quoting an inflation number to you, is that 33% of that inflation number is made of this. So here's some different charts. So these are all the different moving averages, 200 day, 100 day. Basically, so what this chart is telling you is when these all start to cross past each other. So when they're going to the downwards, that's how you kind of know we're, the 200 days up here. That's the green one, as you can see. And once these lines start to cross back through the 200 day, that's a bullish signal. So there's a signal on the bull side, right? So we have a chart that shows a bullish signal. What bears are telling you is that these aren't going to cross, even though they have, and that this 200 day is going to keep trending down, but also these are going to start to go down this way. Like we're just going to go break through all that. So that's what bears are telling you. So there's bullish signals that literally tell you that market's going to go that direction, up. Now here's the big one. Here is the big one. This is what the market is pricing in right about now. This also is why the market's down today. This is where we're at. This is where they think we're going to on the rate. And what the market thinks is that we're going to get to 4.89, maybe 5% in this area. And then the Federal Reserve is going to immediately start cutting down to here. Now, if you notice that it takes until 2025 to get down to this level right here. This chart right here is why this market has gone up about 11% in 1 month. The NASDAQ has had the best month since January of 2001, if that wants to give you a general idea of how much this market. And the reason why is what you're looking at right here. Now, what the Federal Reserve is saying is that this chart is not accurate, and that they're going to keep these rates higher up until about here, somewhere in here probably, before they even think about cutting. This market is already pricing in rate cuts that looks basically something like this. So who's right? This is basically, we don't have sticky inflation. Inflation drops by probably here, to be honest with you. And then the Fed is like, so inflation ends up being down here, right? And then the Fed looks at it and goes, oh my God, we're at 4.89%, and the inflation's down here. We're slowing the economy too much. We're going to cause a recession. So now the kind of like wait and see mode is out to June or something. So here's our GDP. Basically, bears were saying this was supposed to be negative, if you want to know what's going on. So if every bear you see on Twitter right now is talking about this number right here, they're talking about how the consumption number was low and this number was low and that number, and the only reason this number was positive, it's positive. It's positive. So there you go. Yeah, it's basically like you never saw bears like trying to dissect these numbers. Like you never saw bears trying to dissect these numbers when they were coming in negative GDP for the first part of the year. Now all of a sudden it's coming in positive, and bears are like, no, you see what's going on. It's sad. And then also they're calling for Q1 and Q2 to be negative. Maybe we have to see. Consumer spending is not stopping. Everybody's getting their tax returns. I don't know what they're going to need, like corporate spending or government spending to go down for that to happen. So here's some different charts. So here's one for the bear case. Here's one for the bear case. It's basically we get up to this point right here. These are people that like to do these chart comparisons from 2008 to 2009. So they just overlay the charts on top of each other. So basically they think we get up to here, we rocket up to here, so the bulls get their way and then the bears get their way on the way down. So this is that perfect scenario that the bears want. Now the problem is if you look at this chart, there's something about this chart you should notice. Is this chart goes up, goes down. This was the bear scenario last year, and this is a problem. And I wanted to point this out is because this is what was supposed to happen according to all the bears on Twitter. And this is why you don't listen to bears on Twitter, is because sometimes they're just really wrong. So what ended up happening is we got down to here, and then we were supposed to go a little bit up in December, and then we were supposed to dump in January. But now everybody's changing their story and changing this right here, this big drop they're talking about. See how it goes down to that 3,200 level? They're changing this to all of a sudden say, oh no, we didn't mean January, we meant June. You see how that works? So just be aware, when people are overlaying charts like this is what you get. Gold is, whoever's investing in gold is really having a good time right now. So some people are starting to think we're kind of in this little area right here where gold just kind of goes up after we get a recession. So just be aware that's kind of what people see gold doing. But this required a whole bunch of spending and stimulus, so just be aware. And then here's that inverse head and shoulders pattern from previous time that this has happened throughout the years. And this is what they're talking about is going on right now. So this is basically a new bull market. So you can kind of see, we kind of had this down. We broke through the downtrend, and then this is where you took off to. Now here's the really big one. This is the leading indicator, leading economic indicators. Whenever the leading economic indicators, I think it's like 8 different things that these guys measures. Whenever it hits this little line right here, in a negative trending way, every little red line is a recession. 100% of the time, this thing has been able to call a recession whenever you hit this little line right here. Recession soon followed afterwards. Is this wrong? Is this the one time that it's wrong after going all the way back to 1960? Nobody knows. Is it going to magically pull back and this will be the one time that we don't have, like, even when it got right here, these are recessions. These are declared recessions. Job losses, negative GDP, that type of thing. Do we, I don't know. Can't tell you. Leading economic indicators are screaming recession. But, so that's the big one for bears. So this is a more perspective type of thing. So what I did is basically I pulled out my portfolio, for example, and compared it to, say, I pulled it out the back going to 2020, for example. And you can kind of see everything that everybody's talking about right now is involved in this little part right here from like March until now, or from January to January. But if you pull it all the way back, you can kind of get a general idea. You could do this on your own 401k. You can kind of see that people are freaking out about this little thing right here and what's the market going to do tomorrow kind of thing. If you get some perspective, you can kind of see how far the market is actually run in that period of time. Every one of these is still up, even with last year. Now, if we dump another 30%, whatever. But so here's the NASDAQ from 2002, for example. You can kind of see it went down. We touched it. Like, this is the the trend, and then we went down. So this is kind of what bears are talking about right now. Something like this. This is the bear scenario. See that right there? We had that bull rally, and they're like, oh, see, this is identical to 2002. We'll have to see. This is a lot of stuff that broke in this period of time right here, by the way. You had a lot of fraud. You had a lot of people that were like, I don't even trust this market. You had Enron in this period of time. You had just one thing after another, like global companies that blew up at this point. On top of a tech crash, this is also that same thing. So what is this? This is the current portfolio. So this is a breakdown of the just different things that contribute to the different reports. Where are we at? Oh, this is a great chart. You can pause on the video if you want to kind of see this one. So this is basically hard landings versus the soft landing scenarios. So you can tell 2011. So everybody was definitely doom and gloom in this period of time, 2011. But we're going to get another 2009, and it ended up being a soft landing. But just be aware rates are much lower during these periods. So that's all my different charts. Like I said, for me to go over every one of these charts, and I even left out a lot of charts. I didn't even cover what the dollar's been doing, what the dollar could do, this video would be an hour and a half long. And I don't like to keep my videos that long. That's kind of ridiculous. So you can kind of get the general ideas as to why I went passive, because I'm tired of following the doom and gloom stuff. And I even looked through my prior videos. I don't even talk about my stocks. There's other people in other YouTube channels that talk about their stocks all the time and what each individual stock did in that 1 week or 2 week period. That's fun, I guess, but you know, I don't. That's not what my channel is. I kind of talk about all the different data that's coming in and what I kind of think is going to go on. So right now, what do I think is going to go on? I don't think the consumer is nearly as weak as Wall Street bears wish they were. I think right now for the first half of the year, you're going to get a lot of people that get a lot of tax returns, and I can kind of see it in like my DoorDash money, just the different money that I get from DoorDash and whatever, just going out and doing different things. First half of the year was very weak, or first part of the month was very weak. You can see in my this last part right here, so you can kind of see right around December 1st started to fall. My earnings per mile started to fall, followed through at the beginning of the month, and then as you can kind of see when people started getting tax returns in this general area up in here, and then all of a sudden it got better. Um, People tend to exhaust their tax returns typically by the start of the next quarter, because they pay bills or whatever, or they invest it, or they buy something. So we'll have to kind of see how things start to go from here to here. This is when bears think everything's going to start to weaken again, and we're going to get that recession. So we're going to have to see how this period goes down in right about there. That's where bears say we're going to get the recession and the market crash that they want. So we'll have to see in April. That's kind of when everything's going to kind of go down. But watch it. Like I said, the only thing that you need to watch the inflation reports. If inflation starts to go below 4%, core inflation, excluding energy and all that stuff, core inflation is the one that you need to watch. If that goes below 4%, that gets rid of the sticky inflation narrative stuff, and you're going to see this market take off by a lot, because they're going to these rate cuts right here, all this like rate increase stuff, that's going to go away. Like this market is going to price out those rate cuts very quickly. So you need to watch the core inflation is the big one to watch, because that's what the Fed is watching. So we'll have to go from there. Watch jobs data, of course. If jobs data collapses all of a sudden, then the market's going to be happy that a bunch of people are out of work. So, unfortunately. So, that's where we're at right now. Like I said, if I wanted to go over all this in detail, this would be an hour and a half video. So, that's like I said. So, that's where you're at right now. So, that's the big one. Just watch core. All right. So, thank you all, and y'all have a nice day.